Ever
I
get tired
went,
of hearing wins?
no,
No,
stay
never.
winning.
All we do is win, 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 no matter what. With you.
Today is closing day for my friends on their house.
Yeah, it is.
Yay.
Aaron's closing a deal.
I went to a really cool networking event last night where I met some cool, interesting people
Really
and
cool.
had nice conversations. Yeah.
Nice, Gary. Live here and that. Well, I'm glad two of you were working yesterday. Thank you. What about the rest of you?
I spent the day playing with the new Lone Wolf.
Yeah.
Trans.
Did it bite you?
No, it's actually very user friendly.
It really is. It honestly is, I think, easier than DocuSign.
I prefer it over DocuSign, but I still like Dot Loop first.
Yeah, get out of here, Eric. No one likes you. No one likes Dot Loop. Nobody.
Zillow does.
No one likes Zillow either.
I know.
Zillow's like the weird cousin you have to hang out with on the holidays because their parents brought the potato salad.
Oh, I was a weird cousin.
The parents bring the potato salad. Better not have had fucking mustard in it.
It did.
Ew.
We didn't have potato salads at my gatherings.
I'm going to Fabby's house. Their cookouts are way better than ours.
We didn't have that.
You know, my family's had that bratwurst and potato salad. You know what?
You guys had
Fabby's
like,
has?
what are those deviled eggs?
They have margarita and home violence. I'm in.
Ooh, I love double days.
No, 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 no. My family does not like that.
Okay, no
Double
more
days
burgers
is
then.
fantastic.
Got it.
No, that's a stereotype, Dan. That's not okay.
It is totally fine, and you know it is.
Just do shots of tequila.
Oh yeah, we did that once. No, thank you. My family and tequila is always a fun times.
Let's talk about some family issues. That'd be a fun call.
Family issue Friday, guys. We talk about family issues every single day, and their issues are: how do I buy a house in this market?
Nice segue.
You like that? It's
No.
called pulling it back
It's
to
way
center.
more fun to talk about drama and issues.
We've got every family's got drama and issue, guys. That's what families are. There's no isolation of perfection out there, and people are chasing perfection or chasing something that doesn't exist. And I only bring up stereotypes because it's funny because I've lived them. My family was your atypical white. I want to say white trash because I think white trash looked down on us. Family gathering. But when you've seen an 80-year-old woman swing a 50-liter pot, you know, those big, tiny, like giant boiling pots for doing crab boils and stuff, and throw it across the room, you learn fast reflexes.
You don't hang out in the room.
No, you don't. You were told to get out of the kitchen, stay out of the kitchen. There was a reason for that. Because as a child, that's no place for a child. That was a war zone. All right. Good wins, networking events, deals closing. But we also got Sam here. Sam, what wins are you seeing as it pertains to mortgage rates, mortgage applications, buyer activity, consumer confidence? Anything that we can talk about that's going to stir up some of our agents to go and talk to their databases and get real estate to happen.
Yeah. So the last couple of years, we've seen a lot of like the temp buy downs, negotiated into purchase contracts. And this year, resoundingly, I've seen a lot of permanent buy downs, which is super healthy for the overall economy, buyer market.
Can we take a step back just a hair? I know there's some people on this call that don't quite understand the difference between temp and permanent.
Okay, so a temp buy down, there's a few different iterations of them. You'll hear like 2-1 buy down, 3-1 buy down, 3-2-1, different variations of these numbers. So 3-2-1, 3-1. The first number is the essentially rate that you'd be paying less on your mortgage, and the second one is for the term. So like a 3-1 buy down, or sorry, that's uncommon. A 2-1 buy down would be 2% less for 1 year. So the way that works is escrow holds a portion of seller credit in a separate account, and they make that payment on the client's behalf for the year as if their rate was 1% or 2% lower. So like let's break a 1-0 down. So if rates today are 6.25, the buyer would essentially be paying 5.25 for the first year. Their actual rate would still be 6.25. Their actual payment would still be at 6.25, but escrow would be holding a portion of seller proceeds and making that difference, that payment difference on their behalf. Those can be helpful for clients to obviously alleviate the mortgage payment burden for the first year. But as soon as that year is up, that rate doesn't index, but that proration goes away. So the rate or their payment jumps drastically. I've never been a huge fan of them. I think that they create false confidence. Buyers, just people, have memories of a goldfish, and so we are also habitual creatures, and we will adjust our spending habits based on our current spend. And so when that year ends, if rates haven't adjusted down, they can't refinance. It usually leads to obviously a lot of shaky confidence with buyers, which is not a great situation. So a permanent buy down is essentially if you qualify for 6.25, you're collecting seller credit or you're paying points at closing to buy the rate down permanently to a lower rate. So you go from 6.25 down to like 5.25. That 5.25 then is locked for 30 years or until you refinance. So that is, in my opinion, that's a much more stable approach. And given, it's still very much a seller's market, but given the volatility in the market and obviously values sort of declining over this, kind of high we saw during, honestly, over the past 6 years, we've seen this kind of run up from COVID and then it plateaued and then it slowly declined a little bit. All that being said, it's created an environment where sellers are anxious to sell their house, and so the ability to get seller proceeds to do a rate buy down is much higher. But we're actually using that, I think, as a general market in a more meaningful way. So instead of doing a temp buy down and putting a Band-Aid on something that needs to have a full tourniquet and all that stuff, we're effectively managing it a little better, I think. That makes sense. That's a positive thing. That's a really positive thing. What that does is, so all the people that were in temp buy downs, they are now dealing with the realization that rates haven't come down to 4 and their payment has indexed. And so they're faced with, hey, we've been in the house for a year. Do we sell it and take a loss? Do we try and, sell something else and manage this payment? It's not creating a very great environment for them. So again, I've never been a fan of temp buy downs. Seeing those go away and the market kind of move more towards a permanent buy down, I think is a healthier sign of things to come. It creates just a more stable housing economy. Yeah, what are your guys' thoughts? What do you see in the market? What are you experiencing?
Can you do me a favor? Can you give us a number? Like how much would it cost for a seller to permanently buy down 1% of, let's say, a $400,000 house at like 6.25%?
Yeah, so it's a bit arbitrary because it's based on the bond market, right? So the bond market fluctuates on a daily basis. The cost to buy that down is going to change. It's based on a percentage of the loan amount, but that percentage is going to change day to day. But as a rule of thumb, to buy it down 1%, you're looking anywhere from like 1.5% to maybe 2% seller proceeds to buy that down. So in essence, I mean, it's not much different, temp buy down versus a permanent buy down. And we're seeing the bond market improve a lot this year. So, that's where the affordability piece is being, it's changed this year quite a bit. But yeah, as a rule of thumb, you're like 1.5% to 2% to buy it down in percentage.
I mean, when you're looking at around 400 grand, that could be expensive for a seller.
Yeah.
Be expensive.
Yeah. But if you look at so I mean, there's so Texas, I do a bunch of loans in Texas as well, and that market is really interesting because a lot of times they are already sort of factoring that in to their net proceeds is offering a seller credit, whether that be for just general credit for repairs or for something like closing costs. Closing costs that essentially can go towards buy down as well, but it is expensive. But I think that if you're kind of already planning for that, it makes more sense for the buyer. But 2% on a $400,000 house is a lot of money.
Can the buyer buy down their rate or is
Yeah.
it only seller? Oh, okay.
Yeah, so with the temp buy down, the buyer can't buy the rate down, but with a
Has to
permanent
be a
buy down,
permanent. Okay.
yeah, the buyer can definitely do that.
That's cool.
Yeah.
Where-
Yeah, so with my buyers, I mean, we go through all those options and kind of look at it. And in a in a falling rate market, doing a buy down doesn't make a ton of sense because they're just leapfrogging where the market's going to be in 6 to 12 months or longer. In a rising rate market, it definitely makes sense. Either way, you can sort of rationalize it because that money you're spending towards your buy down it goes in that we're going to go into like mortgage 102 lingo here, but that goes into box A origination charges, and those you can write off at the end of the year against your taxes. So if you spend $20,000 on a rate buy down, a large portion of that can go against your taxable income, which obviously can help lower your tax burden. There's always a way to sort of organize it or set it up towards going to be a benefit to the buyer.
Thank you.
Yeah, good question.
Just locally in Tucson yesterday, Lennar and Rocking K quoted me 3.75 permanent interest rate.
Yeah, so Lennar, so big builders, nationwide builders, they will buy like a batch of rates. So the way those work is, let's say that I'm Lennar and I have 100 homes to sell, and I have to sell these homes before the end of Q2. Have to, because I'm going to hit hard money lines and a bunch of other things. Well, most of these big nationwide lenders have their own mortgage company, and they can buy what are called batch rates. So if the market is at, let's say the market's at 6%, and they want to offer 3% to get rid of this inventory, they can essentially pay for points on a set amount of volume. So let's say they have 100 homes. Let's do the math really quick here. Here's someone quick. 100 homes at, what are they selling for?
$350.
Yeah, and right now you have to do that by May, because by June it goes up to 475.
Okay, so they've essentially bought the batch rates until the end of May.
Exactly.
Okay.
Yeah.
So they're buying the equivalent amount of mortgage-backed securities. They're buying a buy down, like a big batch buy down. The benefit to them and to the buyer, obviously, is, well, to the buyer is they get a much lower rate if they close by a certain time. The downside to that, and why you don't see a lot of lenders doing that, is if they do not sell all that inventory, or in other words, lock all those rates by that expiration date, they get hit with a huge penalty. So it's obviously risky. Lennar and D.R. Horton and a lot of these other big builders, they have that down to a science now where they're like, well, hey, based on data we have, we know we can sell these houses at by this period as long as we discount them to X. But anything that happens, it can put them in hot water. But generally speaking, the big rate buy downs where they're offering a much lower rate than market rate, you're going to see that only with builders because of that feature. It's the same as like so like I offer like lock and shop programs. A lot of other lenders offer lock and shop programs. But let's say that Jim comes to me and he says, hey, I want to buy a house. I don't know the exact house yet, but I'm for sure going to buy it before June. And I only want a payment of, I don't know, $1,200 a month. And he qualifies for, let's say, $350. We can lock his rate in and buy that down and say, okay, Jim, you have to close by June. Or, I mean, he's not in deep shit, but I am at that point. But we'd have to close his loan. So it's the same thing. It's just on a much bigger scale, if that makes sense. So they're essentially locking the rate in ahead of time and buying those rates down to whatever they want to set them at. A lot of times, I'm just gonna keep talking if no one has questions, but a lot of times that will incur like an upfront cost to a buyer. So like in my previous company, we used to offer the lock and shop program. I don't see a huge benefit to it, but in the case of Jim, if he wanted to go do that, I would typically charge him 1 to 2% upfront. That's non-refundable. So Jim's going to give me 1 to 2% of whatever he's shopping for. I'm going to hold that in a kitty, and if he doesn't close by then, I mean, it's kind of SOL. Trying to pick on you, Jim. I would figure you'd make much more, better financial decisions, but today, not so much.
I should jump on a call every Friday with a lender.
Not just a lender, he's a lending professional.
Yeah, get it right, sir.
He is our finance wing of the Rise and Thrive shenanigans. Are you guys? Is this too highbrow? Are we getting it? Is it making sense?
I get it.
Okay. I mean, this is something I know that some agents are like, I should know this, but I don't want to. Don't look stupid. I don't want to look stupid. I look stupid all the time, guys. I trip on my words. You can look stupid too. I don't want to look stupid by not knowing it, but ask the questions. I actually had a plan today to ask Sam to talk to us about FHA type of guidelines, like what kind of houses and what things to look for and things that get bumped on in appraisal. I think it's super important that you guys have a grasp of an overview of this, not level of knowledge that Sam has. You're not the lending professional. He is.
That's
But
actually
really
a great segue.
So
So let's definitely do the FHA one. And I want to pull my buddy up for that. But before we do that, what
need a
are
chair?
some what? Yes, sir.
Okay.
What are some we call them dumb questions. What are some dumb questions you've been afraid to ask a lender because you're like, I don't want to look stupid? This is a safe space, everyone. We can ask the dumb questions here.
please.
What's a dumb question that you're like, you know what? I should know this, but I'm not going to ask because I should have known that years ago or months ago. No one has dumb questions. I'm impressed. All right.
No,
Every
there's-
question's a good question.
Exactly.
My
I
most
see it.
recent dumb question that I learned was that the rate lock doesn't happen until the buyer signs the disclosures. Am I
Yeah.
correct about that? I was like, what? Okay.
Yes and no. So typically, yes, unless you're doing like a lock and shop program. So in 99.9% of the cases, you cannot lock the rate or order the appraisal. That's another one to know until they sign initial disclosures. Same is still true for the appraisal, but with a lock and shop program, you can lock the rate ahead of time. They just pay that 1 to 2% up front.
Yeah, that was something that I was like, oh, I should probably know that. Because my lender was asking me to get the disclosure signed or to follow up with the disclosures. I'm like, they're different from my disclosures. I forgot about that.
That's a good one.
Damn, I got a dumb question for you. How
Uh,
far away, Max?
Yeah, so once the shopper pays 1 or 2% of whatever they're shopping for, that money goes towards the loan or
No, so with a lock and shop program, generally speaking, is non-refundable. So like that money is they're just throwing that up into the atmosphere. Well, not in the atmosphere, it's into some really big fat banker's pocket. I'm not big and fat, it doesn't go in my pocket, but it goes in someone's
Okay.
pocket.
Thank
Yeah.
you.
Yep.
Is that like we moved like 13 times. So every time before we would go to the other state to look for a house, we would lock in a rate. Is that the same thing that you're talking about where you lock in the rate?
So let me ask a few more questions to clarify. So when you would move prior to you finding a house or getting a contract, you guys would lock the rate in. Yes, then yes. Yeah.
I just have never heard it called lock and shop or whatever you were saying.
You know, there's so many different names for it.
Okay.
Yeah, lock and shop. There's I can think of a couple others, not right now, but yes, there's a bunch of other names for it.
You can lock the rate, you can shop the rate, but you can't pop, lock, and drop it. Remember that.
Shoot that thing up, mommy.
I love Max. He's always there with he's like at the end of the line. His brain's all he's what I'm shooting for.
Pop, lock it, drop it down to the floor. Tell your lender.
Here's a great
Lock it,
question,
drop
right?
it.
On a lock, how long do they last?
Say it one more time.
On a lock, let's say someone is locking the rate, like as you're the buyer side or even listing side, how long does a lock last?
That is a great question. Okay, so most locks you're going to see for 30 days. However, you can lock anywhere from like 5 days to 90 days. It really depends. So obviously, the longer you are locking it for, the more cost you're going to incur, not just because of just the lock itself, but you're freezing mortgage-backed securities, the price of them in time for sentiment, for like whatever, 90 days. Because there's going to be a lot of volatility and market fluctuation, lenders have to essentially hedge that bet. So they're like, okay, well, if we own the rates right now for let's say a 1% margin, and we lock up 90 days, there could be a 2 to 3% swing either way. So either A, we're going to make money in 2% more than what we bought it for, or we're going to lose 2%. So generally speaking, the longer the lock is, they will hedge their bets by increasing the cost of that to kind of. The thing is, lenders are like casinos; they don't lose, and they make damn sure of that. So, unfortunately,
I mean, that's the most prophetic way I've ever heard anyone describe the mortgage industry.
yeah, it's the world we live in. I am just a messenger.
Thank you, Sam. You're honest.
Yeah, man, you have to be. I mean, the reality is like the reason I got into this is because there's a hell of a lot of shenanigans that go on behind banking doors, and I'm here to kind of dispel the rumors and all the other stuff that try and bring some fact to it.
Well, here's a question I've answered in the chat, but I think it'd be a good thing to talk about globally. Is if someone assumes a VA loan, can the vet qualify to use their VA right after?
Yeah. Yeah. So the VA has a thing called remaining entitlement. So as long as they have remaining entitlement left, they can purchase again.
What if they don't have remaining entitlement yet left?
They would still qualify. They just would have to bring a down payment in. So the VA loan, you can still use a VA loan, get the interest rates, which are substantially better than a conventional, do all the stuff with a VA loan. The only thing that you're looking at is the guarantee, right? So if you want 100% guarantee, meaning they finance 100% of it, that's what we're talking about. So when a veteran does not have any remaining entitlement left, the entitlement is the guarantee that they are entitled to because of their service, right? So if there's no entitlement left or a portion of it, so let's say, for instance, they find a house, it's the dream house, they just had their home sold, and the person assumed it, and they had $100,000 left in their entitlement. They want to buy a $300,000 house. Well, there's only $100,000 of that $300,000 house that is going to get guaranteed. The remaining portion, they would bring a down payment in just like it was a conventional loan. It's different because they're paying a much lower down payment to qualify, but still they're bringing a down payment in. So it doesn't disqualify them from buying a house. It just means that that the terms change slightly.
What if the assumer is a VA eligible buyer?
So if the assumer is a VA eligible buyer, they can transfer entitlement, which in that case, it's frees up the departing Viet their entitlement. You have to use your slang there, Viet.
The assumee and the assumer.
The assumee and the assumer, yep.
Is the remaining entitlement a dollar amount?
Yeah, so it's sort of yes and no. So every veteran has $36,000 of entitlement available. That money is set aside for their upfront. So every VA loan has like a guarantee fee or a funding fee. First time use is 2.15, subsequent use is 3.3% of the loan amount. And that 36,000 goes towards that upfront fee. So that's essentially what they're covering is that funding fee.
Gotcha.
Here's a fun fact. Actually, a lot of people don't know this. So if at any point, let's say Jim, we'll pick on Jim again, was on SEAL Team 6, right? And he's bought 19 houses during his career as a SEAL. And somewhere along the lines, he trips over a box of ammo and he hurts his knee. And then years later, they're like, you know what? Actually, that was a service-related injury. We're going to give you 10% disability. Well, Jim's already bought 19 houses and paid 19 funding fees. The VA, as long as they can prove that service-related injury happened before he purchased any one of those homes, they will refund that funding fee back to him. So actually, I had a group that I
So
ran.
when someone gets an increase in their disability, they can go back and get funding fees refunded.
So any disability percentage over 10%, their funding fee is waived. If Jim had bought these houses prior to him having 10% disability, and then they deemed that injury or disability occurred before he bought those houses, they would refund that funding fee back to him.
That's what you get for tripping over ammo boxes, Jim.
I know, Jim. SEAL Team 6, man, you'd be better than that.
And only 19 houses with all that good stolen gold? Come on.
I mean, Jim was making all the decisions today. Here's the thing, though. The VA doesn't like people to know that. The VA is awesome. They honestly are one of the best lending establishments out there, but no one is 100% honest. They don't like people knowing that, so you have to kind of like know who to talk to and how to get that money. But I've done that for I don't know. I should actually sit down and count how many people have done that for, but a fair amount of veterans have got a big chunk of money back.
My brother-in-law works in the VA disability department. I wonder if he even knows that.
I don't know, but the first one that I did that for, this dude, so he got like $86,000 back, and I had worked with him for like, I don't know, it was a little over 2 years to fight the VA and get this money back. The first thing he does is he buys a Hellcat Red Eye and wrecks it the next weekend.
That sounds like a veteran.
It was awesome for a week.
At least it wasn't a V6 Mustang.
That's the other one. Yeah, he upgraded a little bit.
That was his first car.
That was the first car.
$1,200 payment.
Yep.
I mean, I want a Hellcat Red Eye, but
dude, he calls me. He's like, "Hey, so can I look at doing a cash out?" And I was like, "What do you need a cash out for?" He's like, "Well, so insurance doesn't really want to cover the Hellcat." And I was like, "What? You just bought that?" And he's like, "No, like it's wrecked now." And I was like, "What the?"
Why would
don't do donuts in a parking lot of a grocery store. Yeah.
Or just don't do donuts.
Or just don't do donuts.
Well, today's been insightful. Did you guys learn something?
Don't do donuts in a grocery store parking lot.
Hell yeah.
Unless you're in a red eye Hellcat.
Do donuts in your cul-de-sac in your neighborhood.
Yeah.
There you go. Yep.
Let's not be reckless, okay? The rules for the weekend is don't add to the population, don't subtract to the population, stay out of jail, okay?
All right, next Friday, bring all your FHA questions. Let's do an FHA question. Then what we're going to do is, can I share? Let's see.
Yes.
Maybe. Oh, I can't share.
We're not doing the light screen again, are we?
Nope. Can we see this though?
Yeah, we can see it.
So this it's still called Domain. This is now every LO. This is my AI platform that we've developed for the past 2 years. This is a one-stop, one resource for loan officers nationwide. But this right here, we're going to go in next week and we're going to ask it all the FHA questions. So I'm going to deselect these. Someone throw me an FHA question you have always been curious about.
What's the lowest credit score possible?
I can type, damn it.
Are you typing with your thumbs today, Sam? What are you doing?
Both left ones.
No, I'm a tapper. Yeah.
Good morning, Mr. Dove.
All
Okay.
right.
5-8.
500. So fun fact, I actually, it wasn't 500, it was like 505 or something like that, but I've approved a 505 FHA buyer before. The reality is, I don't want everyone to run out and start selling 500 FHA clients. It's super, super hard. So to have a 500 credit score and still be approved, you have to have 10% down, but they still have to have, like, generally speaking, a pretty good credit profile, which doesn't happen if you have a 500 credit score. So 400s and 400 to 500, that range is like you have active lates, you have charge off credit cards, you probably had a car repoed, you just have not made great financial decisions. What I have seen, and this is what happened with this client with the 505, is they had filed a bankruptcy because of a divorce, and since the bankruptcy they hadn't done anything wrong, they just hadn't done anything right. So their score was still in that 500 level, but they didn't have they had this like obvious gestalt or stop in their timeline where like all the bad stuff happened and now they just weren't doing anything, and so their credit score kind of maintained at 500. But generally speaking, you're not going to find someone with a 500 credit score that has the credit profile that would get them approved, because they will still look for stuff like late payments and charge-offs and things of that sort. But yeah, the lowest eligible score is 500 if they have 10% down.
That's insane.
Yeah, it's pretty crazy.
Well, good. Sam, thank you for your time. Thank you for your awesomeness.
Always.
We got to get running. Guys, remember, Sam's here for your real estate questions on finance stuff. So please, he's in our group chat on the Rise and Thrive group chat. You can also have his cell phone number directly. He'll put it in there for you. If there's anything you need, send your people there. Sam is licensed in Arizona, Washington, Texas, and a handful of other states. Give him an opportunity. He pours into you every week. Let's pour back, shall we?
Mm-hmm.
This is like a quid pro quo.
To give a little, you got to get a little. Or to get a little, you got to give a little.
Yeah, both ways, right? All right, friends. Have a fantastic weekend. I'm excited for the wins on Monday. Let's make some big things. I want to hear, let's beat our goal. 2 weeks ago, we put 8 deals in escrow over the weekend. Can we do 9?
I think so. Look at these winners.